Hi again, everyone. It's Mike on Money. Today we're talking about the secret of successful investing. And we've got a fun little example here to help you better understand what that secret is. Let's imagine that you either win lottery and you win $2 million tax-free, or maybe you inherit $2 million from a rich uncle you didn't know you had. But either way, suddenly you get $2 million and you decide you're going to invest it. Now, here's the thing. You're thinking to yourself, man, there's this one stock I've been dying to buy. I know it's going to be a winner. I want to put my money there, but you don't really want to put all $2 million on one stock. I mean, what if it goes belly up or something? I'll put half of the money in some kind of a diversified fund, and the other half I'll put in that stock I want to buy. The first year, here's what happens, right? You put the money in the fund, and here we have it on the screen. The fund that you pick, the diversified fund, it's up 30%. 30%! How awesome is that, right? You're like, oh, I'm a winner, I'm so smart. And then even better, the stock that you picked that year, that baby's up 60%. Woo! You are like the world's best investor, right? You are rocking and rolling. The fund's up 30, the stock's up 60. Heck, you're probably thinking, man, I should put all of it in the stock, but whatever, we're happy in both outcomes. The next year rolls around. Your fund, the diversified fund that was up 30, it's down 10. But now see what happens is you do the math here, right? You're like, okay, I'm up 30, I'm down 10. The math says that's 20%, and over 2 years, that's like 10% a year. Not so shabby, is it? What happened on your stock or Bitcoin or whatever it was you bought? Well, that was up 60. This year it's down 40. But again, you do the math. You're like, oh, I'm up 60, down 40. That's still a 20% total return. I'm still up 10% a year on average. So it's kind of like, got the same thing, right? To really see how this all works, this is just the math. We need to marry your money to the math. Here we are, we have our $1 million in our fund, our stock fund. We're up 30%, so we're at 1.3 million. You're like, okay, that's cool. We're down the next year 10%. What's 10% of up 1.3 million? It's 130,000. So at the end of the day, we start with $1 million. We end at 1.17. Not so bad, right? We're okay with that. Now, how did we do over here? With the stock, remember the first year we were up 60%. 60! That's awesome. That's 600 grand. 1 year. We're the world's best investors at that point. But remember what happened the next year? We lost 40, right? We lost 40. What's 40% of 1.6 million? If you pull out your calculator, it's 640,000. Guess what? Uh-oh. We managed to have a positive gain of 20% over a 2-year period. And guess what? Average 10% a year, but somehow we lost money. We lost 40 grand. We averaged 10% positive each year. We lost 40 grand. What happened? Here's a little dirty secret for you. When you're looking at the same average return, tighter ranges lead to different results. Tighter ranges are more efficient and you end up making more money. We could say that hitting singles in a baseball metaphor, a batter who hits a lot of singles and doubles will beat and do better for you than the batter that hits home runs but strikes out. Let's take a look at why losses hurt more than gains. Let's look at a very simple example. We're going to assume that you start the year with $100,000. And let's say it's a bad year and the market's down 20, so you're down 20%, and that's $20,000, so you go from 100 to 80 in 1 year, down 20. Now the question is, how much do you have to make the next year just to break even? You'd say, oh, I'm down 21 year, I guess I need to make 20 positive the next year. Well, let's find out. So we start the year number 2 with 80,000. We get a positive 20% return. What's 20% of 80,000? Uh-oh, it's only 16,000. You're not back to your 100 grand yet. Turns out you need a higher percentage to get back to even. So let's figure that out together. If you've got $80,000, you need to make 20,000 to get back to even. What's 20 in relation to 80? What's that percentage? Turns out it's 25%. You need 25% return to make up for a 20% loss. Now, it's kind of interesting as you're saying, yeah, well, Mike, you made us lose money in the first year. Well, if it were the opposite, it'd be different. No. We could start with we could flip this around. I mean, you could do, this will be homework for you to do at home. You could flip the returns around. You could say, what if I made it the first year and lost it the second year? It's the exact same stuff. It works out exactly the same. Losses hurt you more than gains help you. Now, let's apply this to the real world and how markets work over time. Now, on this spreadsheet, let's imagine that we have $1 million and we invested in the stock market, like the S&P 500, way back January 1, 2000, right? This column is showing you the year-by-year returns. And if you see like a dark green with green shading, it means that the market had a 20% year or better. Red, well, we know that's bad. Red means a loss, and red with gray shading means a double-digit loss. And the first 10 years starting in 2000, if you would have put $1 million in the market in 2000 and you just bought and held it, guess what? 10 years later, at the end of 2009, after 10 years, you only have 900,000. You lost money, 100 grand over 10 years. And you're probably thinking, what? I thought I was supposed to make money over time. By the way, during that 10-year period, you had 2 of those years were 20 plus return years. Problem was, you had a bunch of negatives. Like, oh, we're at 900,000 10 years in, but this is long-term investing. We keep holding, and then we hold another 10 years. Look what happened now. We go all the way up to $3 million. So now, after 20 years, you go from $1 million to $3 million. Now it's not so bad. In fact, we go a couple more years by the end of 2021, which would be 22 years in. You're up to $4.8 million. From $1 million to almost $5 million, it took 22 years. Yeah, we started out pretty bad, but boy, did we finish strong. Let's compare that to a more diversified portfolio, because look at this. Look at all these double-digit gains. Like when you win, you're winning big here. You're hitting home runs. But when you lose, oh boy, you see those big red numbers? When you lose, you're striking out big time. By the way, what you're going to notice, they are both going to average the exact same number. They're both going to average exactly 9% a year, 9.01%. They're going to have the same average return, but let's see how much money we end up with if we just hit singles and doubles instead of home runs and striking out. First of all, here we are. This is our million in the market going to 900,000. We looked at that just a minute ago. Look at this. Not so many 20% years, but not so many losses. Look, instead of being 900, we're at we almost doubled our money. So first 10 years, hey, this is our winner for sure. Look at 20 years in. We were at 3 million here, 4.7 million over here. Clearly, still our winner. And in fact, as we finish our 22-year period, 4.8 million, 6.2 million. Again, exact same rate of return, but $1.4 million more. Why? Losses hurt you more than gains help you. Over on this column, we don't see a lot of home runs. We don't see many years. There's a couple years that are 20% years, but you hardly ever see it. But you know what else you don't see? You don't see a lot of that's the only double-digit loss, just one time in 22 years. Meanwhile, over here, we've got double-digit losses happening, 3 times. It happens more frequently. On the left, a lot bigger returns sometimes are good, but also a lot bigger losses. And at the end of the day, when you add it all up, same average return, the one that hits singles and doubles, more money because of that simple issue. Losses hurt you more than gains help you. Rich people know this. Wealthy investors know this. Your big institutions know this. When you talk to big institutions, they actually want to know, before you talk about your returns, they say, wait, you don't control the average return, Mr. Money Manager. You do control the risk, though. Tell us about how you manage risk. That's their first question because they know that stuff. Now you know it too. That is the secret to successful investing. It's not about getting the average up. It's about being more consistent on your annual outcomes. That's how you win the game. All right, that's our episode this week. Hope you found it helpful. Talk to you again soon.